Hey friends, thanks so much for joining us again. I have Ron Hera from Hera Research on the phone. Ron, welcome back.
Hey, Sean, thanks for having me on.
Oh, thanks for joining us. Guys, I just want to make you aware that Hera Research subscribers include financial advisors, fund managers, and accredited individual investors. Ron is one of the smartest guys out there that I've had the pleasure to meet personally. And Ron, you wrote an article recently that we posted called Financial Crime to Trigger Final Collapse. And basically what you covered in this article is you're saying that there are three general ways in which the U.S. dollar system could break down. Why don't you take us through these three general ways in which the U.S. dollar system could break down?
Sure. Well, the first general scenario is this idea of a sort of traditional run on banks and a domestic collapse of confidence. In other words, the idea that people would rush out of the currency, that there would be a race to shed currency in favor of any type of hard good. Now, that type of problem usually starts with mistrust of the banking system, or it could be triggered by accelerating price inflation, and then therefore triggering a rush to basically get anything for your cash before it loses more of its value. The next scenario is really the one John Williams talks about, and that's the government finance situation. So if the government can't service its debt, then obviously its finances become what I would just call farcical. And the theory here is that the bid for Treasury for U.S. Treasuries would evaporate, that there just wouldn't be any even foreign or even domestic bidders for those Treasuries, that the bond yields would rise, that the government would have to default, that the Treasury market would collapse, the dollar would collapse, and that incidentally could trigger a rush out of dollars here at home. So there's a question about what I call chains of causality as to which one would come first, or which one could happen all by itself and therefore perhaps cause the other two. The third scenario, of course, is that U.S. dollar's reserve currency status, and that's a situation that many analysts have been looking at and basically citing different examples of how that status is breaking down, and most of that is correct, although I would only really disagree about the timeline in which the world reserve currency would ultimately transition to a different currency.
Yeah, your article's so fascinating. I was rereading it again this morning before the call and taking notes. And one of the things I was thinking is it would be almost fascinating for me to title this video, is John Williams' 2014 prediction for hyperinflation wrong? Not because John Williams has his facts wrong, but as you rightfully point out, Williams assumes the market for U.S. Treasuries is a free market. And that's fascinating because, as we know, the Federal Reserve could continue to manipulate the U.S. Treasury bond yields and could continue this game really for an indefinite period of time, well beyond 2014.
Right. Well, that's the basic issue. So John Williams uses gap accounting to project a point where the government's finances become farcical, and by that I mean that there's no way for the government to operate without direct debt monetization. Once we reach that point, John Williams believes that the government's finances will collapse. And there's a lot of numbers to back this up, so I just want to be perfectly clear that I believe John Williams is correct in the entirety of his analysis in terms of the data and the logic of his conclusions. I only think that he's wrong about the timeline because really a couple of reasons, and you mentioned one of them, which is the bond yields. There's a presupposition in John Williams' analysis that the Treasury market is a real market, and I don't believe that's precisely the case. I actually did an analysis of Treasury auction data, and I went back, I think, 2 or 3 years. I had a lot of data and analyzed it. And what I observed was that even throughout the crisis of 2008, there was not any indication of Treasury auction distress in terms of yields. In fact, yields fell. And what you can see if you actually look at the data is that there are direct bidders, unnamed direct bidders to the Treasury, which in lockstep take up any slack left by foreign bidders. So when you see that, what you come away with is that, okay, there's not any sign of distress even at the worst point of the crisis. There's always a bidder there. And so my belief is that there always will be a bid there. And, as for who the bidders are and what the mechanism is, I can only imagine that it might be the Federal Reserve and its primary dealers as agents. But setting that aside, because we can't be sure who those bidders are, they could potentially be pension funds or other domestic institutions, we don't know. But the point is that it's clear that there's always a bid there for the Treasuries. So the idea that, once the government has to borrow in order to operate, in order to service its debt, and the debt is snowballing away at a crazy rate, that therefore there would be a collapse at that point, or as we approach that point even, potentially in 2014, I believe that's wrong. And it's wrong simply because it's not a real market. There's another issue with the, John Williams and the Treasury bond yields, and you mentioned yourself, the Federal Reserve is there with basically an unlimited checkbook to twist the yield curve or to intervene directly to directly monetize debt, and therefore bring those bond yields down. Or, the central bank, the Federal Reserve's own primary dealers can borrow from zero at the Fed, turn around, buy, Treasuries for 1.5 or 2%, and that's a pretty good game for them. With very little risk, actually, because the Fed is actually backstopping the system. So it's not clear to me that the yields will rise, because that is premised on the notion that it's a free market, that the Treasury yields are a free market. That's not the case. It's premised on the idea that the Treasury market is a real market, and that's not precisely the case. And finally, with respect to John Williams, there's another issue as well, which is it's not just the Treasury auctions and so forth. There's a question of what is the world tolerance. I mean, it's implicit in the previous discussion, but what is the level of world tolerance for U.S. monetization of debt? And as a practical matter, I think it's already been shown since 2008 that the world tolerance for U.S. debt monetization is no less than $3 trillion. And it's probably much higher than that, potentially a large multiple of that. So if that's true, I mean, if the government, if the Federal Reserve funds the government of the United States, and the federal government's finances become increasingly farcical, the idea that therefore there's a collapse of the currency is probably wrong in terms of the timing, because in fact the world is tolerating and has tolerated a very large amount of monetization. I mean, $3 trillion is not a trivial amount. We're talking about the Federal Reserve's balance sheet, basically. And that could expand tremendously, and it's already not credible that the Fed could unwind the $3 trillion balance sheet. They're buying mortgage-backed assets right now. They're saying that they're going to eventually sell those back into the market. I don't see how that's going to happen.
Okay, so we've pretty much covered in detail the second scenario, U.S. federal government debt and unfunded liabilities, correct?
Yeah, and John Williams, right? So if you want to look at the domestic collapse of confidence, that's one that I don't think would happen first. And there's a couple of ways that it could happen.
And I just want to weigh in, because you wrote, and I thought this was fascinating and what great insight, you wrote that, quote, U.S. households do not generally have cash, and they generally rely on electronic conveniences, credit cards, debit cards, automated payroll deposits, etc. Plus, we have no practical alternative currency in this country, so you're writing that, therefore, the impetus to flee the banking system or rush out of the U.S. dollar is unlikely to originate domestically. And I thought, wow, what a great point.
Yeah, to put it bluntly, they don't have any money. So the idea that they're going to be a traditional run on the banks is really, it doesn't make a lot of sense. The average household doesn't really have a lot of cash. We have a lot of electronic conveniences today, whether that's automatic paycheck deposits, automatic bill payment, credit and debit cards, etc. So the idea that people would rush to the bank and take out all their cash presupposes that they really have any cash. In reality, it's a sort of the banking system is sort of an electronic pass-through. As money flows in, it flows out. So it's not clear to me that there would be that. I mean, given the FDIC guarantee and the fact that households don't really have a lot of cash in the bank, I don't see a traditional run on banks in that sense. Now, there's another scenario domestically that could cause a rush out of the currency. In other words, a race to shed the currency, and that's if you had runaway inflation. And right now, John Williams has inflation set, I think, around 8 or 9%, and that makes sense intuitively because that lines up roughly with the U.S. federal deficit. In other words, as a percent of GDP, the government is spending an additional amount of money into the economy that's roughly equivalent to John Williams' inflation number. So just intuitively, that suggests that John Williams is probably about right. But 9% inflation is not enough to trigger hyperinflation. Now, there's an argument that inflation could accelerate away, and that hasn't happened yet. If you look around the world and you see countries that suffer from 15, 20, 25% inflation year after year after year, that's a disaster, and it's a crisis. But they don't necessarily have a collapse of the currency. So we have a ways to go, in other words, from the inflation view. Inflation could literally double or triple. And it's not clear that until you reach that point or past that point that you actually would have a hyperinflationary collapse of the dollar here at home.
Okay. Well, you also note that the 1971 closing of the gold window by Nixon was one of those points of no return. And then you rightly argue that if history is any guide, additional points of no return lie ahead for the U.S. dollar. And I found that fascinating because as we talk about the world reserve currency status of the U.S. dollar, you're arguing that the dollar still has probably a lot of legs under it because, what alternative does the world have? I mean, we've got the petrodollar, there's the Chinese renminbi, the troubled euro, which you write about, the IMF special drawing rights, which I think is It's kind of what they've set up for their one world currency, at least as it relates to central banks and how they, trade between themselves. Correct me if I'm wrong. And then South American countries with the SML, and then of course there's gold. Why don't you take us through the world reserve currency status of the dollar and why you think that the dollar has legs for the foreseeable future?
Yeah, let me make add one last thought to the domestic hyperinflation question, and that is that if you look at recent examples of hyperinflation, let's say Zimbabwe, for example, there always was some kind of alternative currency there. So the idea that people would rush out of the native currency, there always was a black market in some other currency. That doesn't exist in the United States. So that's just an additional thought about, well, how would the collapse of confidence occur domestically speaking? And so getting back to what I mentioned at the beginning, this chains of causality, I don't believe that a domestic collapse of confidence in the dollar would be the first domino, so to speak, right? That could be the result if government finances were to collapse or if the dollar broke down as a world reserve currency, then ultimately there would be a rush out of dollars at home potentially, but I don't believe that would happen first. And certainly the government finances are on track for an ultimate crisis. But now let's talk about the world reserve currency status. A lot of people talk about China when they say, okay, the dollar is about to break down as a world reserve currency. And I would agree with that. The dollar, it's not about to break down. It is breaking down. It has been breaking down for quite a long time. If you look at just the euro, you have the European nations trading with each other in euros. If you look at, you mentioned the SML in South America. That's another regional trade agreement. So, for example, Argentina and Brazil can trade in one another's currencies. The BRIC nations can trade with each other directly in one another's currencies without using the dollar. China is probably the biggest issue when it comes to the reserve currency, because there's a lot of speculation that China could actually take over the role of the United States. Now, China has currently 18 bilateral trade agreements to trade in RMB with countries in Africa, South America, etc. The most significant one is certainly China's agreement with Japan, because those are the second and third largest economies in the world. And that's a situation where, I'm not trying to trivialize it or dismiss it at all, because this is serious. But at the same time, if you think about it, 18 bilateral trade agreements, that's less than 10% of the countries in the world. There's over 200 countries in the world. China has agreements with 18. The fact of the matter is the RMB is not fully internationalized. And I would also point out, and I don't mean to, this isn't a facetious argument at all, that the United States has military preeminence. The United States' position is dominant in the world, and especially at sea. And China is not prepared to take over anything like that role. I mean, they simply don't have the capacity to do it. I mean, they have a lot of men under arms, but they don't have the Navy to do it. Not only that, the currency war, as Jim Rickards has called it rightly, is actually a Cold War. It is not a hot war. And so for China to take active steps against the United States and against the dollar, that would turn the currency war into a hot war. Well, that's a different paradigm. And the risk there, of course, is that there could actually be a real war. And in that scenario, the United States has nuclear weapons on aircraft, at sea, and on land all around China. And China doesn't really have a navy to match that of the United States, or for that matter, really an air force. So this idea that China is going to suddenly take over is simply wrong. China is not prepared, not in a position. It's not in their interest to attempt that. Another thought with respect to China is, they're sitting on, last count, I heard there was 800 billion of U.S. treasuries, and I don't know how much U.S. dollar cash the Chinese government actually holds. But the point being that, China's rushing to dump those assets to crash the dollar and to switch to their own currency as the reserve currency. That would cause them to lose their own savings. That would destroy their own reserves. So China has been slowly unwinding that position. They're buying oil and resources all around the world, trying to buy Canadian oil companies. So China is slowly unwinding that position. They're buying lots of gold, for example. But this is a gradual process. The idea that it could suddenly accelerate, that China would just say, okay, that's it, we're taking over, that's completely wrong. They can't really do it, and it's not in their own interest. The final issue here is there are other things that could cause the dollar to unwind, and I just want to be clear that, we're not talking about, for example, the pile of OTC derivatives that's 700 trillion, and even the net credit exposure is 70 trillion, which is the equivalent of the entire world's GDP. So I'm not talking about other things that could happen. So you can imagine there's various force majeure types of events, right? There could be war in the Middle East. There could be another financial crisis, with the epicenter being OTC derivatives, for example, in J.P. Morgan, another, 10 times bigger London whale type of problem. I'm not talking about any of those things with respect to what could cause a breakdown of the system or a breakdown of the dollar, because obviously those things would make the situation worse. I call them accelerators, right? So there's various black swans, things you can't anticipate that could happen potentially, and there are things that might happen that would greatly accelerate the timeline, right? So maybe 2014 would be too late, and actually we could have a crisis even before that. But those accelerators haven't actually materialized, and there's also decelerators. So, for example, breakthroughs in fracking, America's own energy independence with cheap oil and gas here at home, implementing the Pickens plan, things like that we could do if we have the time between now and 2014, things we could certainly start, if not finish, that would be decelerators, that would slow down this ultimate breakdown that we're really are headed for. Now, with respect to SDRs, there has been some thought that should be used now as a world reserve currency, that it's a virtual currency that's really comprised of a basket of other currencies. And, that's an interesting idea, and it could work. However, that would be the one world sort of currency, but it's not in the interest of the U.S. financial institutions. So if you think through what are the biggest banks in the world and who's backstopping those banks, it's the American banks and it's the Federal Reserve. They still are the dominant players in the entire global financial system. So it's not in their interest to switch to the SDR, and therefore it's not going to happen until after a complete breakdown of the dollar.
Okay, so there's numerous ways that the U.S. dollar system could break down, and so we've covered the U.S. dollar as the world reserve currency. We've covered the eventual consequence of U.S. federal government insolvency, and the third one, domestic failure of confidence. All three are very serious and could happen at any time. But let's get back to the point of your article, which is, quote, financial crime to trigger final collapse, which brings us to really the fourth possible way, and the one that you're really most concerned about, I think, and that's a black swan?
Yeah, that's the ultimate point. So now this final point about the financial crime wave, I see that as an outlier risk that could actually blow up at any time, and it could become a much bigger problem. And the real issue here is that I see that the too big to fails. This is creating a problem not just of moral hazard, but of escalating moral hazard. If you review the wave of financial crimes that has occurred just in the last year and a half, it's incredible. And it's accelerating. I mean, if you break it down over time, there are more of these basically scandals, they're calling them in the media generally, but what we're really talking about is financial crimes. We're talking about fraud and collusion and conspiracy. These are serious issues, and it seems to be accelerating. So if that's true, then that is a growing risk, and it could be a systemic risk to the whole financial system and ultimately to the dollar, because the U.S. financial institutions are at the center of it. So that is a problem that would cause not a traditional run on banks in the sense that people would rush to the retail bank and take their cash out. We talked about that. That's an unlikely scenario. At least it wouldn't happen first. It could be an ultimate result. But what it might cause is a run on financial markets. So as people start breaking their IRAs, breaking their 401k, saying, you know what, these markets are fraudulent. I'm getting eaten alive by high-frequency trading and front-running, and the firms are failing, and they're keeping the cash, and you don't have any protection of customer funds. Now, to be clear, that's happened only in commodities with the MF Global failure, and it hasn't yet jumped into the equities market. But the potential seems to be there, and it hasn't happened yet, but it could happen, and that would be a game changer. If you had the failure of a major financial firm and a loss of the customer money, or creditors of the firm being put in front of the actual customers and their segregated funds, that would cause a real crisis in the financial markets, because once fund managers start to say, you know what, I can't protect my clients, I've got to get this cash out of here. Maybe put it in gold, for example, as Ray Dalio has suggested. Once that starts, if that gets started, that could actually cascade into a total collapse.
You're absolutely right about the commodities having been where that type of fraud has occurred, maybe most overtly. But I guess by extension of that, couldn't we argue that we've actually seen it in the Madoff scandal? We've seen it with PFG Best. We've seen it with just money vanishing, and with folks have money essentially that was supposed to be in the stock market vanishing, and people having no recourse, which again is the same loss of confidence, and this level that people reach that they're so fed up that they just quit the system and take their money out. Kind of the same thing, huh?
You're right. I mean, there are examples that are basically accelerating. I mean, there are more and more frequent examples. And if these examples continue to compound and escalate, and that's what I'm saying about escalating moral hazard, right? Each time one of these things happen and no one goes to jail, and it's the customers are on their own to try to sue and get their money back. This is a huge risk to confidence in the entire financial system. And if that confidence fails, and this is probably the most crucial risk to confidence in the U.S. financial system right now, it's financial crime.
Ron, just the final word here before I let you go. We know that the death of the dollar is on the horizon. We just don't know what the timeline is, right? That's the bottom line.
Well, that's exactly right, and my argument is fundamental. And based on all my analysis, my argument is that the timeline is further out than most analysts. You've got two different camps, right? You've got analysts that dismiss the idea and analysts that believe firmly hyperinflation is on the horizon. I believe that it's on the horizon. I just don't think it's as close as some of the other analysts like John Williams believes.
Well, Ron Hera of Hera Research, thanks so much for calling in. We really do appreciate your time. We appreciate your perspective, and thanks for your wonderful guest posts.
Well, thanks for having me on. I enjoy it.
Okay, my pleasure. We'll talk again.
All right, talk to you later.
Well, that does it. Thanks for tuning in, and thanks for supporting. And if you don't mind, check out thelibertymill.com. Real news, 24/7, 365. Thanks for watching. Good night.